There's something odd that happens when markets start moving. The volume goes up. Not just the trading volume, though that certainly does. I mean, the actual noise. The headlines get bigger. The predictions get bolder. The television anchors lean forward a little more. And somewhere in all of that, in all that sound and fury, people start making decisions they wouldn't make on a quiet Tuesday afternoon. I've watched this happen over and over again across decades. Smart people, thoughtful people, people who run successful businesses and raise good families, they get caught up in it. Not because they're foolish, not because they don't understand numbers, but because when everything gets loud, it becomes almost impossible to hear yourself think. And when you can't hear yourself think, you start listening to everyone else instead. The thing is, wealth isn't really lost in the dramatic moments everyone remembers. It's lost in the noise, in the hurried decisions made because it felt like something needed to be done right now, in the complexity that got added because simple didn't feel sophisticated enough, in the movement that happened because standing still felt irresponsible, even though standing still was exactly the right thing to do. I've been thinking about this a lot lately, about what actually protects wealth when things get chaotic. And I keep coming back to the same realization. It's not complicated strategies. It's not insider informa. It's not even being smarter than everyone else. It's something much quieter than that. The first thing I notice about people who keep their wealth through difficult times is how comfortable they are with calm. That sounds simple, maybe too simple, but it's not the same as being passive. There's a difference. Being calm means you've thought things through before the noise started. You know hat you own and why you own it. You've made your decisions when you could actually think clearly, not when CNBC is showing red numbers and your neighbor is talking about what he just sold. I remember years ago sitting in a room with a man who'd done very well for himself. Old money, the kind that's been passed down and grown for generations. And I asked him once what his secret was. He looked at like I'd asked a strange question. He said his grandfather taught him to make investment decisions on Sunday mornings, not because Sunday had any special properties, but because Sunday morning was quiet. The markets were closed. There was no urgency, no ticker to watch. You could just think about whether something made sense or it didn't. That idea stuck with me because most people do exactly the opposite. They make their biggest decisions when things are most chaotic. When stocks are falling fast, they sell. When stocks are rising fast, they buy. It feels like action. It feels responsible. But it's really just reacting to noise, not responding to reality. When markets crashed in 2008, I watched people sell good businesses at terrible prices. And these weren't bad bazine. They weren't going anywhere. But the fear was so loud that people couldn't hear anything else. They couldn't hear themselves saying, wait, this company still makes products people need. It still generates cash. It's just cheaper today than it was yesterday. That should be good news for a buyer, not bad news. But noise drowns out that kind of thinking, so people sold. And then 2 years later, or 3 years later, they bought back in at higher prices because now the noise was positive. Now everyone was excited again. The same people, the same pattern, just reversed. And wealth, real wealth, transferred from the people who listened to the noise to the people who didn't. The calm people, the ones who didn't sell, they weren't smarter, they weren't braver. They just had this ability to tune out the urgency, to sit with discomfort without needing to act on it. That's a rare quality. Most of us are wired to do something when we feel uncomfortable. Markets know this. Markets exploit this. They create discomfort and then offer us the relief of action. But that action, more often than not, that's where the money gets lost. There's something else I've noticed over the years, the peep, the do well, who really build something lasting. They have this quality of patience that almost looks like indifference. They're not indifferent, not really. They care deeply, but they're patient in a way that confuses people who are used to urgency. Markets create urgency artificially. There's always a reason something needs to happen now. A stock is moving, a report just came out, an opportunity is closing, and all of that might be true, technically, but it creates this feeling that if you don't act immediately, you'll miss something. And that feeling, that urgency, it's expensive. I knew a woman once, a teacher, who invested a little bit from every paycheck for 40 years. Same amount, same day. Didn't matter what the market was doing. Didn't matter what the news said. Didn't even matter much what she was buying, though she kept it simple, just broad index funds, nothing exciting. And after 40 years, she had more money than most doctors I know, not because she was clever, not because she timed anything, but because she was patient, because she understood something that most people don't. Time works. You just have to let it. That's hard for people to accept because it do. Doesn't feel like enough. It doesn't feel active enough. We've been trained to think that wealth comes from doing, from moving, from being smart and quick and aggressive, but that's not usually how it works. Usually it works by being patient and letting good businesses do what good businesses do, which is grow slowly and steadily over long periods of time. The problem is patience doesn't make for good television. You can't build a news segment around someone who's doing nothing. So we don't see those stories. We see the traders, the people making big moves, the people who got rich quick. And we think that's how it's supposed to work. But for every person who got rich quick, there are 100 who got poor quick trying to do the same thing. We just don't hear about them. And there's an side to patience that people miss. It's not just about waiting. It's about being comfortable with waiting, being comfortable with the idea that nothing interesting is happening right now, that your portfolio looks the same today as it did 6 months ago. That's actually good. That's the sign of a patient investor. But it doesn't feel good. It feels boring, and boring feels wrong in a world where everyone else seems to be doing something exciting. I've also noticed this interesting thing about complexity. When people start feeling uncertain, they tend to make things more complicated. It's like they think complexity equals sophistication, and sophistication will protect them. So they add more positions, more strategies. They start using words like hedging and arbitrage and derivatives. A and D, maybe sometimes that makes sense for institutional money, for people managing billions with specific constraints. But for most people, for people building wealth to live on, complexity is just expensive noise. Every layer of complexity costs something. It costs fees. It costs attention. It costs clarity. And most dangerous of all, it costs understanding. Because when you don't fully understand what you own, when you can't explain it simply, you're vulnerable. You're vulnerable to the person selling it to you. You're vulnerable to your own fear when things move. You're vulnerable to making decisions based on not wanting to look foolish rather than what actually makes sense. I remember reading once that Buffett's advice to his wife for after he's gone was to put almost everything in a MPELE index fund. Not because that's sophisticated, not because it's clever, but because it's simple and it works and she'll understand what she owns. There's wisdom in that people miss. If one of the greatest investors who ever lived is saying keep it simple, maybe the rest of us should listen. But simple doesn't sell. Nobody makes money off of you if you buy something simple and hold it for 30 years. So there's always pressure to add something, to get into something new, to make it more complex. And that pressure, that noise, it costs people money. I've seen people with perfectly good portfolios, simple portfolios, 3 or 4 funds, well diversified, doing exactly what they should be doing. And then they meet someone, or they read something, or they attend a seminar, and they're convinced they need 12 more positions. They need international small cap exposure. They need emerging market bonds. They need alternatives. And maybe there's some marginal benefit to all of that, but it's marginal. And the cost in fees and taxes and complexity and confusion, that's not marginal. That's real. So they end up worse off, not because the additions were bad, but because they didn't need them in the first place. They were doing fine with simple. There's another quality I see in people who preserve wealth. It's a kind of restraint. They have this ability to not do things. That sounds backwards, I know. We think of success as doing. But there's real skill in not acting when everyone around you is acting, in not buying when everyone is buying, in no selling when everyone is selling, in just sitting still and letting the panic or the euphoria pass by. This is probably the hardest thing, because not acting feels irresponsible. It feels like you're not paying attention, like you're missing something. Everyone else is doing something, so shouldn't you be doing something too? But most of the time, the answer is no. Most of the time, the best thing to do is nothing. There's this old saying that the stock market is a device for transferring money from the impatient to the patient. I've always liked that because it's true. And the impatience usually shows up as action, as trading, as movement, as doing something because doing nothing feels impossible. I watch people sometimes, good people, smart people, and they'll have a perfectly fine portfolio, companies that make money, businesses that aren't going anywhere, and then something happens. The market drops 5%, or someone on television says something, or they read an article, and suddenly they need to do something. They need to rebalance or protect or take advantage, and they start moving things around. And every time they move something, it costs them something. Sometimes in fees, sometimes in taxes, sometimes just in selling something good to buy something worse because the worst thing was moving. And over time, all that action, all that responding to noise, it adds up. Not in a dramatic way, not in a way you'd notice day to day, but over 10 years, 20 years, it's the difference between wealth and not quite enough. The thing about restraint is it requires confidence. You have to be confident enough in your original thinking to not change your mind every time someone else talks. You have to trust that you did the work, made thoughtful decisions, and those decisions don't need to be revisited every time markets move. That's hard, especially when you're surrounded by people who are always moving, always trading, always doing something. But the H is pretty clear. The more you do, the more likely you are to do something wrong. Every decision is a chance to make a mistake. And in markets, mistakes cost money. So there's real value in just not making unnecessary decisions, in having enough restraint to say, I'm fine where I am. I don't need to do anything right now. I think about this restraint like I think about a good doctor. A good doctor. Or doesn't prescribe something just to prescribe something. A good doctor sometimes says, you're fine, let's just watch it. Let's not intervene unless we need to. That takes confidence. It takes restraint because the patient came in wanting something, wanting action. And the doctor has to have the confidence to say, the best action right now is no action. That's what investors need, that restraint. Add confidence, but it's hard to find because everyone around you is telling you to do something. The financial industry needs you to do something because that's how they make money. The media needs you to do something because that's how they keep you watching. Even your own brain is telling you to do something because sitting still with uncertainty is uncomfortable. There's also something to be said about thinking long-term in a world that's obsessed with short-term. This is connected to patience, but it's a little different. It's about where you're looking, about what timeline you're thinking in. Most of the noise in markets is about what's happening right now, today, this week, this quarter. The news is about what just happened or what might happen tomorrow. The analysts are predicting next quarter's earnings. The traders are looking at today's charts. Everything is immediate. Everything is urgent. Everything is now. But wealth compounds over decades, not days. The decisions that matter, the ones that really make a difference, they're decade decisions, not day decisions. And thinking in decades changes everything. When you're thinking in decades, a market drop isn't a crisis. It's barely noticeable. It's just noise. When you're thinking in decades, you're not worried about this quarter's earnings. You're thinking about whether this business will still be relevant in 20 years. When you're thinking in decades, you're not trying to time anything. You're just trying to own good things and let time do what time does. But most people can't think that way because they're drowning in short-term information. Every day there's news. Every hour there's an update. Every minute there's a price change. And all of that information, it pulls you into the short term. It makes you think short term. And when you're thinking short term, you make short-term decisions. And short-term decisions over the long term, they're usually wrong. I knew a man who bought Coca-Cola stock in the 1960s and never sold it. Not once. Not when it dropped. Not when it surged. Not when people said it was overvalued or undervalued or anything else. He just held it because he liked Coca-Cola. He understood Coca-Cola. He thought people would still be drinking Coca-Cola in 50 years. And he was right. And his children inherited wealth. Not because he was smart about timing. Not because he traded cleverly, but because he thought long-term and then had the discipline to actually stay long-term. That's rare now. Most people say they're long-term, but then they check their portfolio every day. They read every headline. They react to every move. That's not long-term. That's short-term masquerading as long-term. Real long-term thinking, Ian's. You can ignore most of what's happening most of the time because most of it doesn't matter to your actual timeline. And I think this is where a lot of people get confused. They think being a long-term investor means you buy and then you suffer through the bad times, like it's supposed to be painful, like you're supposed to watch your account drop and just white-knuckle your way through it. B, that's not really long-term thinking. That's short-term thinking with long-term goals. You're still thinking short-term. You're still watching. You are still feeling every move. Real long-term thinking is different. It's when you stop watching so closely, when you stop feeling every movement, when a 10% drop doesn't register as a crisis because you're not measuring success over days or months. You're measuring it over decades. And decades, 10% drops are just part of the landscape. They're not events. They're not crises. They're just noise. And here's the thing about all of this, about the calm and the patience and the simplicity and the restraint and the long-term thinking. None of it is complicated. None of it requires special knowledge. None of it is a secret. PE. People know this. Deep down, most people know this. They know that reacting to every headline is probably a mistake. They know that complexity usually doesn't help. They know that patience works. But knowing and doing are different things. And when markets get loud, when everyone is moving, when the noise gets overwhelming, it becomes almost impossible to do what you know you should do. Because doi, what you know you should do, means standing still while everyone runs. It means being simple while everyone is being sophisticated. It means being patient while everyone is urgent. And that's lonely. That's the real challenge, not the technical challenge, not the knowledge challenge, but the emotional challenge of being different, of being quiet in a loud room, of sitting still when everyone else is moving, of trusting your own thinking when everyone else is telling you you're wrong. I think that's why wealth tends to stay with certain families, certain people. Not because they're smarter, not because they have better information, but because they've learned, usually over generations, how to be calm when things aren't calm, how to think clearly when everyone else is panicking, how to stay patient. When patience feels impossible, it's cultural in a way. These families, they have this culture of calm. They've seen markets crash before. They've seen panics before. They've seen booms before. And they know from experience, from family history, that it passes, that the noise always dies down, that the people who stay calm and stay patient usually come out fine. And the beautiful thing is it works. Not every time, not perfectly, but over time, over decades, the calm people tend to do fine. The patient people tend to do fine. The simple people tend to do fine because they're not fighting against the fundamental nature of how wealth actually builds. They're working with it. Markets will always get loud. There will always be crises and booms and predictions and panic. That's not going away. The media will keep pumping out headlines. The analysts will keep making predictions. The traders will keep trading. That machine, it's not stopping. But you don't have to participate in all of it. You don't have to listen to all of it. You can just decide quietly to do what makes sense regardless of what everyone else is doing. To own good businesses, to be patient, to stay simple, to exercise restraint, to think long term. It won't feel exciting. It probably won't make for good conversation at parties. You won't have dramatic stories about big trades or perfect timing. But decades from now, you'll likely have something more valuable than stories. You'll have wealth. No. Because you were the smartest person in the room, but because you were the calmest. Because while everyone else was reacting to noise, you were just quietly doing what works. And that's the real secret, if there is one. Wealth isn't usually lost in the crashes everyone talks about. It's lost in the noise, in the hurried decisions, in the complexity, in the impatience, in the short-term thinking. And it's preserved quietly by people who've learned to tune out the noise and just focus on what actually matters. The markets will keep moving. The news will keep coming. The noise will keep getting louder. But you don't have to move with it. You can just stay where you are, stay calm, stay patient, and let time do its work. That's not exciting, but it works. And in the end, Working is better than exciting. Surviving is better than spectacular. And quiet, steady wealth accumulated over decades that beats Lou. D. Flashy gains that disappear just as quickly as they arrived. So when the markets get loud again, and they will, just remember that you don't have to get loud with them. You can stay quiet. You can stay calm. You can trust what you know to be true. And you can let everyone else chase the noise while you just sit there patient and simple and restrained, doing what wealthy people have always done, which is nothing much at all.